Welcome back to European Markets. My name is Peter Schaffrik, and today is the 25th of April 2023. The last time we were recording, we were talking about the stress in the financial system, and we were arguing at the time that it's not going to be a systemic crisis. However, we also said that there's going to be some kind of fallout for the economy as a whole. And today, I'd like to take a closer look at that fallout. First of all, it's important to recognize that there was some stress in the credit markets to begin with. The two charts that you're currently seeing showing lending standards as measured by the ECB's lending survey and money growth. And both were showing signs of stress already. Tighter lending conditions and falling money growth. And this translated already into substantially weaker lending by banks to the corporate sector. And you can see that in the next chart where the last 2 months were already negative. So this is the starting point that we went into the financial turmoil. And it's unlikely going to be any better since. The next bank lending survey is going to be published on the 2nd of May, and we're likely going to see a further deterioration in credit conditions. But obviously the key question is, how does that translate into GDP growth? The equation that you're currently seeing on the screen is a stylized version of how GDP growth and its components come together. And the two encircled parts are the ones that typically are the most reactive to tighter lending standards. So let's take a look at investment. The next two charts that you're currently seeing show investment in the residential and non-residential part of the economy, alongside the so-called credit impulse, so the change in the growth rate of credit provision. And as you can clearly see, there's a very strong correlation. It thus stands to reason that investment is going to slow quite a bit, potentially even be negative going forward. The question is whether that is sufficient to drive GDP lower. And here I think the answer is not necessarily. In fact, we've got a case in point. If you look at the UK, and the next chart shows business investment in the UK, that has been flatlining essentially since 2016. Yet, the UK managed to eke out not spectacular, but still decent growth numbers over the same period of time. Hence, there must be something else at play. And that something else is consumption. Consumption has been relatively strong, and consumption is a larger contribution to GDP than investment, typically. Yes, it is also driven by lending standards, but not only. The chart that you're now seeing shows our analysis of what drives consumption. And as you can see, a much larger contribution comes from the so-called employment component. So whether you are in a job and therefore have money to spend. And as long as the labor market remains strong, consumption growth is likely going to stay strong. And this is probably the key unknown at the moment. How will the labor market react? At the moment, it stays very firm. And there are very little signs of any slowing in either the UK or the euro area. In the chart that you're currently seeing, we've modeled consumption growth under various assumptions for the labor market. And as you can see, it needs a substantial weakening in the labor market, akin to 2008, 2009, to drive consumption growth really negative. Under more moderate assumptions, it can even stay positive. And in fact, that is what we've been seeing for quite some time now. So how does that map into GDP? As long as consumption, and which in turn is by a large degree driven by the labor market, stays reasonably firm, so should GDP. Yes, it's probably going to be weaker than where the ECB or some other international institutions currently think it is, and we just revised our GDP numbers lower, but it can stay positive and we can avoid a very large-scale recession. In fact, we think that this is going to be the story for the second half of the year, the weakening of credit conditions and how it impacts the economy. And I expect that we'll return to that topic in future editions of this video series. So to conclude, credit conditions are tightening and they're probably going to tighten further. That's going to impact investment. It's probably going to impact consumption too, but that's much more dependent on how the labor market's going to react. And so far, it's staying strong. We reckon that next week, the ECB will hike interest rates. probably by 25 basis points, but will indicate that they have more to do. The Bank of England in the week thereafter probably also going to hike by 25 basis points. There's a better chance that they'll stop there, but the risk is clearly to the upside. And that's what markets have been pricing for some time now. Furthermore, going forward, we think the risk is clearly that central banks will communicate that the implied rate cuts that the market currently sees at the end of this year and 2024 are not forthcoming. And that will be the fallout for markets from everything we just discussed. I expect that we'll return to that subject, and I hope you're going to join me again in a future edition.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.